Welcome to TMS Insights. It's just on the cusp of the end of the financial year, so a busy time, Ben, but an exciting time too. Things have been rapid in markets. We go back to the recovery after the tariff sell-off. We've had, the Middle East has been a hotbed for a long time, but has really blown up in the last few weeks. And apart from a big up in oil and then a sell-off, equity markets have been really calm and have moved ahead, haven't they?
They have. It's been quite amazing, the lack of volatility through so many big global events that are occurring. So I'm glad to have seen it, but I'm surprised, I've got to say. I thought we'd see a bit more of a reaction.
I mean, markets aren't always logical in the sequence of events that comes out of an economics book, where it says, geopolitical events have got to cause concern and all of this. So there is no playbook. Markets are art as much as science. But we come into this end of financial year in a really healthy state. Markets, whichever one you look at, are on or near record highs. And so that's as good a sign of confidence as anything.
Completely. And, I think the other thing that has shifted this year, which has given markets a boost that doesn't get spoken about as much, is the interest rate outlook. So Jerome Powell is now leaning towards, it looks like, going back into a small cutting cycle. We had that piece of inflation data late last week,
in the US,
which is in Australia with a monthly inflation
that was
data.
this week,
So that's locked in a rate cut again here.
Annualising at 2.1%, so you'd have to think they have
bottom
to
end of bracket. It's the monthly one, so you read more into the quarterly, but I think definitely we'll get a rate cut later this month. As we saw in 2022 when rates went crazy and share markets don't like that, it's milder now, like it's coming down at a slower rate. But
it's that simple though. I mean, that's a known good, and it's there, it's real. It's had a couple of we've had a couple of cuts already, so certainly it looks like that next meeting in July is very live for a cut, and markets are anticipating that 10-year bond's down to 4.1, I think. So certainly that's good for valuations as well. The earnings side of things is good too, Ben. I mean, despite all the noise that you've heard, and I think this is the big thing, isn't it, Ben? I mean, everybody mentions Trump, in the first few syllables that are spoken in any discussion about anything, anywhere. But it's so much the case that what are the actions and what's really going on? Well, companies are progressing pretty well.
Yeah. Well, I'd say we're going to sound like broken records here. There's a lot more earnings growth that is coming out of the US market. And I think, if you look at some recent updates that we've seen over there, they've been very optimistic. The economy there's holding up well. It feels like they're in a really sweet spot. Here, I would say we've got the August reporting season. We're going into a blackout period now. So most companies won't talk to the market for the next month. But we will see negative earnings growth across our market again, based on what the consensus analysts' estimates are. Only -2 or 3, it's looking like. The attention will focus to the FY26 financial year. Hopefully we start to see a return to growth. But I guess with our blue chips, it's probably a bit more lukewarm in Australia. Good income, but not a lot of growth.
So let's look at the Australian market. I mean, the banks have been a phenomenon.
Incredible.
There's not anybody who can explain where some of the prices are in valuation metrics, but you can't deny the weight of money. And the banks have always been a cosy oligopoly here. They've had their glory years in the 90s, and they haven't done a lot for really a long time. So, but recently, Ben, they have been keenly bought.
Yeah. CBA, I think, is up about 54% this financial year, and really has had no change in its outlook. It's just
2% earnings growth.
It's just incredible. It's a trade that's fed on itself, and it's almost actually accelerating. It feels like as we went into the end of the financial year.
It does.
It is a bit of a head scratcher.
Well, most fund managers are certainly not overweight. They're underweight and hurting because relative performance is affected by not holding enough. Can we just maybe look at some of the ones that resources haven't contributed? So our index has had some strong leadership. So resources haven't contributed. CSL's a big weighting stock, hasn't done much. But what it belies is that there's an emerging
Yeah.
lot of interesting companies, and it's probably a good point for us to sort of talk to people as we go into a blackout period. We think of the financial year ahead and opportunities. There are some very exciting companies that we look at, constantly reviewing, that we're not always talking about to clients, but it's good to maybe position a few names in front of people as we go into this quieter time.
Yeah, because I do think in this country, the bigger you get, the harder it is to continue to grow your profits at a steady clip.
You end defending market share rather than chasing it.
Yeah.
So the hunter is in a better phase than the hunted, right?
Yeah.
And so the mid caps and the emerging leaders are the ones that we've got a great interest in. So heavyweights in the index might appeal if you're just trying to replicate an index, but if you're trying to get growth, you want the hunters. And in that space, maybe a few that we want to talk about today. Let's talk about Xero, which has been in the news. Now, this is a bit of both potentially, but it's on the move. A major acquisition and a capital raising this week.
Yeah, huge. So a $4 billion acquisition that's come out of nowhere, a company that I don't think either of us had ever heard of. Melio. And, we're talking about this before, Melio was created 6.5 years ago. It's like it used to take generations to create this sort of wealth. Yeah. It can happen so fast now. It's just insane.
We have to keep this in mind. An unbelievable speed of.
So they're doing a placement. It's a large placement. It's over $1 billion in a share purchase plan. The share purchase plan will be several weeks away from us having to make a decision on a recommendation. So we'll be in touch down the track. It'll depend on where the share price is.
And we know it'll be related to the replacement price, which was $176.
Yep.
And the stock had closed at $191 before the issue. So it'll be
pretty slim discount for that amount of money.
Which is credit to Xero. And
completely. And maybe
Melio as well.
The backers of this. I mean, we learned a lot yesterday listening to Sukhinder, the CEO, presenting. And I've got to say, when I saw the announcement, I was like,
dollars are big.
Dollars are big. It's an unprofitable business at this stage.
So it dilutes them.
Yeah, it does. Yeah. But
it's part of growing their ecosystem, isn't it?
Completely. And she did a very good sales spiel on why this will hopefully springboard the United States arm of Xero, which has been the problem child. It's one they've failed to really get the traction they've got everywhere else in the world.
Doing well in Britain here. New Zealand.
Yeah. So look, I got off the call feeling pretty positive about it. She's got $200 million of stock that in her LTIs, STIs that is locked up sort of past the 2028 guidance of doubling revenue and getting back to Rule of 40.
Yep.
If they achieve that, the share price is going to be a lot higher.
Because it dilutes them out of Rule of 40, doesn't it? Yeah.
It's down to 31, I think, post-acquisition.
But they believe they'll get back there.
Yeah.
So, and we know what that means for businesses that hit that level. Let's talk about Macquarie Telecommunications, because there's been such an interesting take this year on data centres, the challenge to the key thesis of explosive growth. But we don't look any different to where we looked a year ago in terms of the great appeal in this area.
Completely. So this is probably one of the data center plays. NextDC is talked about a lot. Goodman Group,
we've talked about a lot.
And the third I'd say is Macquarie Technology, MAQ. And the difference with this business is it very much specializes in building, owning, and operating data centers specifically for government. And they're not a global business. They're an Australian-only business. It's founder-led. David Tudorhope owns 44% of the business, still runs the business. It's grown its earnings every half for the last 20 consecutive halves. But at the moment, it's in a heavy capex cycle. It's building its biggest ever data center, IC3, in northern Sydney. And these guys specialize in providing higher levels of security. So, the Department of Defence, the Australian Tax Office, the RTA are big tenants in these centres, and they need to talk to each other. So it creates this ecosystem, and they're very sticky. Now,
they're a trusted partner, and they're essential.
Completely.
So.
And they have run into an issue where they had 3-4 year pricing terms agreed with government departments. The cloud providers, Amazon and Microsoft, put up their prices much quicker than expected, and they haven't been able to pass on that margin. But I can see going into the end of this year, some of those contracts will start to be repriced. The capital cycle will drop right off as this new data center comes online.
Cash will flow through to the bottom line.
So it looks pretty interesting to me.
We've seen that with other businesses. We like to buy into that capital intensive phase
Right. Yeah.
when you've got the cash flow coming. Sometimes the market's a bit short-sighted on those things, and you can see a pricing opportunity. They got the sell-off, but not the full bounce back of April to June.
Yeah, I mean, the stock was near $100 a share when everyone was going crazy about data centers. Yeah. Goodman hit $40, next DC hit 18.
Yeah.
This one hasn't had quite the bounce, but it
got the sell-off though, which is good. So good opportunity.
Yeah.
Let's talk about another one, totally different space. One we've talked a bit about, but not widely to people. Pinnacle, which is a boutique investment manager, co-invests, has had a great long-term performance. Ian McCown, the CEO, who we caught up with this year a couple of times, sold some of his holding, which is materially large holding.
Yeah.
And I noticed the stock was down a little bit after the back of that, but this is growing very rapidly, this company.
Yeah, so this is a company that takes purchases stakes in what it rates as the best of breed managers. Now, that might be in private equity, private credit, global shares, etc., etc.
Aussie shares,
well diversified. There's 28 affiliates these days, and buys these stakes at significantly cheaper valuations to what they would typically trade at. And the reason they get to do that is because Pinnacle will then take all of the admin, accounting, all of the day-to-day running of these businesses off the hands of the company. So you improve the profitability, and then they roll their sales and distribution team in to go out and speak to advisors like us about a new offering. And they've got the best sales and distribution team in the country, without a doubt. So their pitch to a manager will be, you guys are great at this niche you're in, but you're only managing $300 million. You're barely paying the bills. We think we can take it to $2 billion, and we want to buy 30% of the company. And if we can get to $2 billion, everyone's going to do very well out of this.
And stay a 5-man team.
And
get
rid of all the hassle of running a business,
admin, and
focus on running a fund. Yeah,
and they do that well. And like you said, the beginning point is selecting well. And when the Royal London team left a year ago, where did they head to? Pinnacle, under the name Life Cycle, and I think that was in global equity markets a massive,
huge
boost.
First time they got a stake in a UK listed manager.
Absolutely. So
a couple in America now as well. And I'll tell you, Ian told me when we had a catch up with him that when they started out, they would go knocking on the doors of fund managers, pitching why to become a Pinnacle affiliate. He said we now get about 300 to 400 fund managers coming to us wanting to be an affiliate, and they'll pick 2 or 3 a year. So
it's
very cash generative business, pays a good dividend, which is nice, and a great founder. Ian's great guy. And
just to give a sense of the upside in these businesses, let's talk performance fees, which work well for fund managers in good times. Hyperion's going to have a big one this year. That's one of their affiliates. That'll flow through to Pinnacle's bottom line.
Hyperion was the first business they bought a stake in. A lot of clients will know because they're invested in the Hyperion fund. The Global Share Fund has outperformed the global market by in the high 20% this year. It's an extraordinary achievement.
Massive.
You very rarely see this, and they have a very long track record of performance. They might earn a performance fee of $100 million this year on the back of that, of which Pinnacle is going to get paid half. In fact, it's probably going to be over 100 million. So we'll find out. But that's the swing factor in it, and it does create volatility in the share price because they don't consistently outperform.
No costs required for that, so you don't apply large multiple expansion on that, but it's great to have. Can increase your dividend, which is really good for shareholders. So it's another interesting one. Look, there will be other ones, but we just want to mention a few there. Quite a time in July, but it's been a really good year to date, and another successful financial year. So last comments from you today, Ben?
Let's hope for another one.
25, 26 being a big one. So
it's rolling around quickly, isn't it?
It is, and we'll be back with some updates late in July and then in reporting season in August.